because remember, to all of us that are listening to this today, Biden would say, hey, you're going to pay 39.6 plus you have California. And let's say California's 9.3, right? So you're looking at 50% tax bill on the sale of the asset in that example, if the capital gain rate goes from 23.8 to 39.6.
Hi, this is Chris German from The Apartment Dealer. Welcome back to The Apartment Dealer Show. This is where we bring you the information, the resources, and the network of professionals that will assist you as you build your financial legacy in multifamily properties. Today, I'm going to be interviewing Mr. Stephen Hall. Steve is a practicing enrolled agent, which is a level above a run-of-the-mill CPA. As an enrolled agent, Steve could represent you in front of the federal government. Steve has been practicing now for over 20 years, and his firm, Robert Hall & Associates, has been in existence for over 4 decades. Steve and his colleagues represent individuals with massive wealth to individuals with not so much wealth and everyone in between. And it's with that perspective, that experience, that they're able to assist landlords like you navigate the tax code, what's current. We'll also be discussing what's proposed so that you can protect your wealth, because a key to being a multifamily investor is mitigating your tax liability so that you have that much more money to put into the next deal. Now, be sure to like this video, subscribe to our channel, turn on notifications. If you're a landlord, you own multifamily properties, you're looking for real information, not some HGTV stuff, but you're looking for real things that you can do as a landlord in the day-to-day management of your properties to protect yourself and grow your wealth. This is what we share. So again, please subscribe, turn on notifications. And with that, please help me welcome Mr. Stephen Hall. So Steve, welcome to the show.
Thank you, Chris. Good. I'm happy to be here.
So for you viewers who are familiar with our educational events, our live webinars, you've seen Steve Hall before. He's nice enough to have given us some of his time today to answer a few rapid fire questions up front, questions that continually come up from landlords and investors like yourself, and talk about Prop 19, and then talk about any proposed tax changes that we may be looking at here as California landlords, and then on a larger scale in terms of the federal government. So Steve, since you're familiar with being a part of our events, you're familiar with the fact that I essentially chunk the investor's lifetime up into 3 pillars. We call it the financial legacy. There's 3 pillars to that legacy. The first one is maximization. They have to get a hold of what it is they currently own, because too many landlords we run into, their approach, to no fault of their own, but really is they know more is coming in than going out, so they must be winning. And they really don't necessarily have a plan. Maybe they don't have a team, by their side to look at this a little bit more sophisticatedly. So in the maximization pillar, again, we're encouraging investors, look, you need to increase the value of your properties from within. That includes capital improvements. And so as we're looking at capital improvements on properties we own, and we're talking about depreciation, maybe if you could quickly explain for the landlords, if I buy a new stove versus I put in new copper plumbing, how does the depreciation differ on those 2 items?
Good question. So if you buy a new stove for a property that you're going to rent out to a tenant, you would simply depreciate it as an appliance on your tax return to offset against your cash flow from the rental property.
And say new copper plumbing or new electrical, new roof, is there a schedule for depreciating an item like that? Do you suggest, and can you accelerate that depreciation?
The answer is twofold. For traditionally, when you file, let's say you update all the plumbing, copper plumbing and electrical in the building, plus you replace the roof for $50,000, you get to depreciate the assets on your rental property schedule over, if it's an apartment building, over 27 and a half years. But however, let's say you have a one-time event where you sold an asset and you have some a large gain of some kind, you could look into what's called a cost segregation study, which is basically a study to accelerate your depreciation, which could be a one-time election to accelerate the depreciation against your other sources of income. if you qualify and you're a real estate professional.
So I'm glad you brought up cost segregation. So obviously cost segregation is more involved. My understanding is you have to hire a company to actually do this study. And rather than just depreciating everything over the 27 and a half years. So for those landlords who aren't familiar with it, number one, how does cost segregation differ from maybe the typical strategy on depreciation? And when would an investor look to use it versus not look to use it?
Good question. So I'm a big fan of using cost segregation when you jump up a tax bracket. So for example, the brackets range from 0% up to currently 37%. So let's say you have a year where you're trading Tesla stock and you made $300,000 in short-term gain on Tesla stock or Bitcoin, for example, and you have additional ordinary income, yet you're a real estate professional. You could elect to file the cost segregation plan. So that way you could accelerate a large loss and accelerate your depreciation to offset against your gains from other sources of income.
And we've maximized what we currently own. We're taking full advantage of the properties that we currently own, but now it's time for us to grow. Oftentimes landlords are cash poor, equity rich, so they look to do a 1031 exchange. If they look to, say, sell an asset to buy another asset, so they're looking at a purchase loan versus I'll keep my building and I'll just refinance my current building to take out equity to buy a new building. How are the two different strategy? Well, not strategies, but a purchase loan versus a refinance, the interest and the write-off of that interest, how do they differ?
So when you have a purchase loan, you can deduct 100% of the interest because for rental properties only, you could deduct 100% of the interest for the property because it was acquisition debt. Now, for primary residences, if you buy a new residence, the government caps your interest deduction to a loan balance of $750,000. Now, if you were to refinance a building, and let's say you have a $500,000 loan on the building and the building's worth $2 million, and you refinance the building for $1 million. So therefore, you're doing a cash out refinance of $500,000. That $500,000 in loan balance, or the interest, or 50% of the interest you pay on that building, is partially deductible if you use the proceeds of the $500,000 to buy additional assets or to grow or to reinvest into your building to make improvements. But if you take, let's say, $100,000 of that money to gift to your grandchildren or to pay for your child's education, that $100,000 portion of the $500,000 will not be a tax deduction. So, for example, let's say the total interest for the $1 million loan is $50,000 a year. The first $25,000 or $500,000 of that deduction will be 100% deductible because that's what you had as the original loan balance. Mm-hmm. The remaining $25,000, if you use 100 of that 500 for college tuition, for example, 20% of that $25,000 or $5,000 will not be deductible because you didn't use those proceeds of interest towards the business or to grow your portfolio. You used it for personal use, such as paying for your children's college.
And versus a purchase loan, so say you did a cash out refinance and all the monies that you were able to pull out, you did buy a new building versus you do a new purchase loan. Is there a difference in the interest there?
If you buy a new building and then if you refinance, take some cash out and buy another building, is there a difference?
Between the write-off of the interest?
No, because you're using the proceeds of the interest for growing the portfolio. So that interest would be deductible.
Okay, excellent. And then the third pillar is preparing for tomorrow. Again, an investor, they've grown over time. Now they're thinking about their heirs. They're even thinking about their exit from real estate altogether. Simple question. They're trying to determine, do I hold my properties in a trust and my kids inherit the properties through that trust versus do I own the property in an LLC and do I give the kids so many shares of the LLC annually? How do you choose between the two?
First of all, an LLC is always a great vehicle. If you talk to any attorney, they'll recommend an LLC for asset protection to protect you from liability, number one. Number two, from an estate planning perspective, if you have many heirs, it's good to communicate through the operating agreement and the living trust that you have that your estate planning attorney could draft to spell out who controls the asset and who owns what asset from a passive perspective. And then from a valuation perspective, an LLC is looked favorably for purposes of appraisals of valuing your estate from a long-term estate planning perspective.
And in terms of the kids inheriting the properties, so would it be your suggestion they're still held in a trust, they inherit that way, as opposed to they're just a part of the LLC itself and there's no trust?
That's a good question. It depends on the size of the estate. However, with that being said, I would recommend you to advise your estate planning attorney as quickly as you can, because we have a new tax administration, and this tax administration so far, with what they would like to do, they could potentially lower the taxation threshold for an estate. Right now, if you have an estate worth, let's say, $10 million, the estate is not a taxable event to your heirs. However, there's always the political risk that the next tax administration could reduce that threshold to, let's say, 5 million as an example. Now, when I said that number, I made up that number personally. That has not been quoted by the current tax administration. I'm just giving you an illustration for illustration purposes only, that the Congress could say, let's lower that threshold to 5 million. Then if you have that lower threshold, that could be an issue from an estate planning tax perspective, especially when we see all these real estate values continue to rise in Los Angeles. So it's important for you to consult your estate planning attorney as soon as you can to review the strategies that are available to you today.
So we're going to talk about proposals that, there's some rumblings of what it is the new presidency would like to do. We'll talk about that in a second, but let's talk about what is fact. And what is fact here in California is now we have Prop 19, which affects property taxes. So my understanding is if you were going to alter anything within your estate or alter title on your properties, that had to be done by February 15th of this year. Has that deadline come and gone?
You asked me the question, what is Prop 19? This Proposition 19 will have severe financial consequences for children inheriting property from their parents. It was approved by the California voters in the November election. Proposition 19 changes what's called Prop 13 from 1978 that was passed in 1978 to limit the rise of property taxes. So what is Prop 19? It is specifically, it allows eligible homeowners may now transfer their bases anywhere within the state to a property of greater value, whereas folks were limited to transfer within certain counties to homes of the same or lesser value. Now, Prop 19, increases the number of times that person may transfer their tax assessment. Now, if you're 55 or older and you have, for example, severe disabilities or loss of home to a natural disaster, like a wildfire that we just experienced the last 2 years, that person will be able to transfer their tax assessment up to 3 times, not just one. But the new law also requires that the market value assessments for inherited properties that are not used at their heirs' residence be reassessed. So bottom line is, if you're an heir to a property that you're not going to live in, it's going to get reassessed to the value of what it's worth today, not the inherited value of what your parents paid for the property tax on that property tax bill. That's the biggest issue with Prop 19 that you're going to have. And that's the negative impact that we have, because in the past, before Prop 19, I could inherit my parents' rental property that they only pay $50,000 for and only pay $1,000 a year on that property. But let's say the property today is worth $1 million. Under Prop 19, when my parents pass and I inherit that $1 million property, I'm not going to be able to pay $1,000 of property tax. I'm going to have to pay up to $12,000-$13,000 a year in property tax on that property, because under Prop 19, if I don't move into that property, I'm going to pay $13,000 hypothetically. But if I move into the property, I'm going to keep the $1,000 value as far as what I have to pay the county. So it's a big difference. In that example, it's a $12,000 difference, $4,000 a month in additional overhead if I do not move into the property. That's basically the gist of Proposition 19, of what's different for those of you that are concerned about your estate plan and what to do. But here's a question. What do you think that's going to motivate people to do when heirs inherit the properties?
Well, you're going to see sales take place, because if that type of upswing in tax basis dramatically changes the cash flow. And I would even say today, many landlords hold their properties because of the tax issue, and they wanted their kids prior to Prop 19 to inherit these properties with the low tax basis. Now that that's all gone and the kids are going to get reassessed anyhow, I can also see landlords going through the 1031 exchange because that no longer is there, as a motivator.
Well, two things. The 1031 exchange won't really matter to the heir because they get the step up in basis, but they'll be motivated to do two things: raise the rents on the property if it's highly undervalued rents, number one, because they have to cover the increased overhead. And number two, the heirs may want to just sell the asset and move that inventory and redeploy their capital elsewhere, whether it's buying another rental property or diversifying their portfolio. So, and what's unfortunate about the legislators that created this bill is they are going to create inflation in rents, additional inflation in rents to the very people they're trying to protect. Because the tenants, some of these tenants that you have, those that are listening today, you probably have kept the rents a little bit lower because they're good quality tenants and you have a paid off asset with very low overhead. So as a result, you passed along your fortune of lower overhead to your tenants. But now with this law, when your children inherit the asset, they may not be able to continue that strategy that you as the patriarch of your portfolio have done, because you're going to have that reassessment of property tax. So now you're going to see a continual increase in rents. That will be unfortunate for some of the folks out there, but it's also a bill that was passed without factoring in the ramifications for the tenant 10 years from now, as far as what kind of rental inflation they will experience as a result of Proposition 19.
And so that we're clear, if there's a couple and there's a death of one spouse, there is no reassessment. It's when the children inherit the property, and if their children continue to hold the property for investment. So any multifamily properties, commercial properties that the parents own that the children now inherit, those properties will be reassessed at today's value and the property taxes increased.
That's correct.
Okay.
That's correct.
And is there any entity that would allow a family to get around this? Let's say, taking it back to the LLC. If the family owned a property in an LLC and the children are members of that LLC, they're gifting shares little by little, does that help them get around the reassessment of the property because it's the LLC that still owns the asset?
That's a very good question. And I had that very question with some estate planning attorneys about a month ago. And the governing body for this legislation is the State Board of Equalization. So the State Board of Equalization, in my mind, is the administrator to verify and validate the transfers of assets, and also the ownership of LLCs that gift a percentage portion of asset A to asset B, or heir or owner number one to owner number two. From the law perspective, now this is my interpretation, and we still are debating this. What is the requirement of the taxpayer? So let's say you have an LLC, and on title, the LLC is the owner of the property. What is the State Board of Equalization's requirement, giving the responsibility to the managing member of the LLC to report to the State Board of Equalization any transfer of ownership of that LLC member interest from party A to party B? So there are some details that have not been completely defined by the State Board of Equalization that need to be defined. So in theory, the way the spirit of the law is written right now is that even if you have an LLC and the heirs are alive, and you transfer the asset to the heir, for example, and the heir does not live in the property, it's going to get reassessed for property tax purposes.
Okay.
So it's important to consult your estate planning attorney to really look at the law and understand the ramifications before you transfer your deeds from party A to party B. And I highly recommend everybody to have a visit with your estate planning attorney that is listening to this today, and at least have a call with them to make sure that your assets are up to date as far as the paperwork for your living trust, et cetera.
The whole issue here with California, and they dream up things like Prop 19 and other things that are proposed, is we have a revenue problem. My understanding was, I was just speaking with Bruce Norris, who you've known before I knew him, but of course he's a part of our educational events. He'll be a part of our upcoming educational webinar. He was sharing with me that the top half of 1% of residents here or citizens of California pay 40% of the tax bill. And it's that half of 1% who, if you try to do things like have a wealth tax and you're increasing taxes, that they will up and leave. I mean, someone like yourself, you've now moved out of state. Now, Bruce Norris himself moved out of state, right? Because of things taking place here, because they need more revenue for all these programs and all these things they dream up. So speaking with regards to California, any current changes to the tax code that we need to be aware of for 2021?
As of right now, the current tax administration has not made any changes to the tax code for what we experienced for 2020 as a landlord. Number one. Number two, if you're a business owner, there have been many changes under the CARES Act that was passed back in February of 2020. And forgive me, with COVID, I forget my dates and timelines, since we've all been staying in our homes, because the last time, Chris, that we were together, from what I remember, was we were in my conference room right when COVID hit in last February. And that was an interesting day, because I think it was literally 2 or 3 days before the county had their order.
We were together March 19th. The stay-at-home order went into effect March 20th.
March 20th, that's right. It was the day before. There was a lot of confusion about what that meant for all of us. And so since that day, Congress has passed what's called the CARES Act. And it's an act that we've all heard on the airwaves called the Payment Protection Program, the Paycheck Protection Program, PPP. And it's a popular program for business owners that can receive relief from the government to keep their folks employed. So if you're a landlord or a property management company that has a workforce on payroll, that program would be available to you to give you some relief from the pandemic, as well as those of you that are retaining your employee. There's employee retention programs, for example, or some tax credits that are available for employers. But for the landlord specifically, there has not been too many changes from the COVID-related pandemic. There's only been challenges from local government, as we've all, I believe, Chris, you spoke about this, where local government has been giving a free lunch, so to speak, to the tenant that is not paying their rent due to COVID, et cetera, et cetera. So that's been challenging for some landlords to collect rent in this environment.
Here's a question I get with respect to a 1031. So you own in California, with many people moving out of state, moving their assets out of state. They do a 1031 exchange. They purchase a property now in Texas. The capital, does anything happen with capital gains, or is California, the way the law is written now, is California owed any money if and when you exit out of that property that you exchanged into Texas, or along the way, is California owed some money?
Good question. So what California has done is, when you 1031 exchange out of California, it's allowed, but you have to file a form with the state of California every year, letting the state of California know that you sold the property, you bought a property outside of California, and where you bought it, and what your original basis was on the asset in California. And as long as you follow that form every year, you're in compliance with the 1031 regulations for the state of California.
And so obviously they don't want to know that information for no reason, right? I mean, they're tracking your equity, is what I guess here.
Yes, they're tracking your equity. So that way, if you ever sell that property, let's say you buy a property in Texas, and then 5 years from now, you sell the property in Texas, California wants to get their piece of the profit from that exchange that you conducted 5 years previously.
Wow. So, there was rumblings of, so now this is what's fact, talk about what's proposed here in the state. There was rumblings that, Gavin Newsom has talked about things like a wealth tax. And of course, his head's on the chopping block right now in the middle of them pushing forward this recall. But for those that maybe aren't familiar with this, what he's mentioned or what's been proposed in terms of a wealth tax, that means what? if you live here in California.
So what the proposed wealth tax was a 0.5% annual tax on your net worth. So for example, if you own 10 million in assets, as an example, the state of California was proposing a wealth tax of 50,000 a year just for the luxury of being a high net worth individual in the state of California. Now, the good news is it never passed the local legislature, but it definitely alarmed as Bruce Norris said it best, that the top half 1% that own majority of the assets are paying 40% of the tax in California. Well, guess what do you think that bill did to those folks? Do you think those folks are going to stay in California, or do you think they're going to move?
Right.
So here's a great documented example of this. Elon Musk left the state of California and moved to Austin, Texas. Now, I'm not going to say that he left solely because of the wealth tax, but I can assure you that California made it difficult for him to keep his factory open in the county of Santa Clara during the pandemic. And when the county told him that he could not operate, Elon simply said, "Okay, I'm just going to move to Texas so that way I can operate." And he left. He left. He sold all of his personal homes, his second, third homes, etc. And his goal is to exit California 100% and have 100% of his holdings outside of the state of California. And that just gives you an idea. So California, when they're proposing these kind of bills, such as what they just did with Prop 19, all they're doing, unfortunately, is hurting those they're trying to help long term with the fiscal revenue they're trying to raise.
Well, and then you run into an issue where enough of these businesses, those that do hold a majority of the wealth, leave the state. So now you're not able to pay the tax bill, and now you default, and who knows what that would look like, right? So, but this is too obvious for politicians. They don't think this way. So let's talk about federal. You already mentioned that there has been no sweeping changes as of yet, but there are 3 proposals that were a part of the Biden tax plan as he's campaigning that would be meaningful to landlords. One was the step-up basis, that they would like to alter or eliminate the step-up basis. So for our listeners, what is step-up basis? And let's just say worst case scenario, they were to eliminate the step-up basis. What would that mean in terms of your children inherit a property and their tax liability?
So what that would mean is if there's a 0 step-up basis, so let's say I have a property that I bought for $50,000, and today it's worth $1 million, and my son were to inherit the building. Under today's law that currently exists, my son will be able to inherit the $1 million building and sell it the next day tax-free. Under the proposed legislation, now this was strictly a proposal, it hasn't been passed. So I want to be very clear to all the listeners.
Correct.
The Biden administration wants to pass that $50,000 basis to your son, to where when your son sells that building for $1 million, there'll be a $950,000 capital gain tax bill, as an example. So there will be a $950,000 taxable event that, let's say, for illustration purposes, what's called the tax bill is 30%. Then you're looking at a tax bill of over $280,000, as an example. If the son inherits the property for $50,000 basis and sells it for $1 million, there's $285,000 tax bill. Versus today's law, the tax bill would be 0. So there could be potentially some dramatic changes, but we have not seen any past legislation or proposed legislation hit the floor of Congress at the moment.
Right. Well, and one thing we share with the viewers is that once it becomes law, it's too late, right? So we have to at least be diligent and know what's being proposed. Now, in addition to the elimination of the step-up basis, they've also proposed taking the federal capital gains rate from 20% to 39.6, nearly doubling the capital gains.
Right.
So now let's go back to the scenario. Your son inherits the building. Not only does he now pay capital gains where currently he wouldn't have to pay any, now he pays double the amount that you would have to pay if you just sold as the owner yourself today. So again, another huge ramification that would have for estates, for families' estates.
Correct. And that's where, and there are other areas that you could offset the tax bill. For example, you could still conduct a 1031 exchange to trade from building A to building B, and as of today's law. The second option is if the house is paid off or the property is paid off, and depending upon the age of the son can contribute that property to something called a charitable remainder trust. And under that charitable remainder trust, the heir will be able to sell the property tax-free and be able to strip out an annuity, a monthly cash flow stipend out of the asset, and minimize the tax liability if the Biden proposes to raise the tax rates to 39.6%. So there are vehicles that are going to be available to offset against that kind of a oppressive tax rate. Because remember, to all of us that are listening to this today, Biden would say, hey, you're going to pay 39.6 plus you have California. And let's say California's 9.3, right? So you're looking at 50% tax bill on the sale of the asset in that example, if the capital gain rate goes from 23.8 to 39.6. So it's a very suppressive tax law that would come into play. And that would just slow down your capital markets. It would just slow down the economy even further, which doesn't make any sense from a fiscal perspective.
And now that we were last together in October, we were contemplating, who would win the elections, what would that mean? Now, obviously, we have a new administration. Anything that in these final moments you would share with landlords to be cognizant of, given I guess you'd say the track record of, those that are in power now?
That's a dangerous question. I think based on their history, they're going to raise taxes. They're going to raise the tax rates, number one. Number two, they are going to create more social related policies to increase the amount of welfare, the amount of free programs for those that qualify that live below the poverty line. They're going to create more laws that are restrictive for those that have wealth. So basically, those of you that have wealth, they're going to try to restrict your growth and your expansion, as an example. Now, how are they going to do it? That's going to be interesting to see how they would propose to do it. And it's gonna. I don't have good answers I don't have a good use case to demonstrate what I just described, because I have not seen what they have proposed to Congress at the moment. All we have is what Biden proposed as a tax rate. For example, Chris, you mentioned that 39.6% tax rate that he's proposing for capital gain. That's all we've heard from the Biden administration up until now. So we don't know what it's actually going to be proposed to Congress specifically. And but I will tell you, based on what Biden proposed during the campaign trail, he will try to raise tax rates. Now, the question is, will he be able to raise it the first 2 years of being in office, or will we have to wait until the next election cycle in 24 months to control the House and the Senate? Because right now, I believe is it a dead even split right now between the House and the Senate? So it can be potentially difficult for him to pass anything at the moment. But down the road, it may be a different story depending upon who controls the House and the Senate in 24 months.
Well, Steve, we're all watching as things develop together. I want to thank you for your time this morning. And of course, we look forward to you being a part of our next educational event coming up. So thank you again.
Thank you, Chris. Happy to be here. And I'm happy to help out all the listeners that are listening to this morning. But more than happy to keep all of you apprised. Chris, I'm sure when something comes up or new legislation comes up, we'll send you the data. And based on what we've talked about this morning, we'll talk about the pros and cons that you can share with your listeners. So I want to make sure the listeners are on your email list, Chris, so that way they could be up to date with the changes.
What would be, if someone wants to engage you for your services, I know that your office offers a free initial consultation. How would they get in contact with you?
They can call our office, the number that you could provide, Chris, and it's 818-242-4888. You can call our office and tell our office that you're looking for a second opinion consultation, and we will review your previous year's tax returns, and we'll be able to advise you based on your current scenario what makes sense for you.
Excellent. All right, Stephen, we'll have your contact information here. And again, we thank you for being on the Apartment Dealer Show.
Thank you, Chris. Happy to be here. Take care.
Now, taxes aren't necessarily a conversation we enjoy having, but it's a necessary conversation. Mitigating taxes, right? Every dollar you save is a dollar earned. So understanding how to navigate taxes successfully has everything to do with how vast your portfolio, your estate, your wealth will become over the course of your lifetime. I hope you found today's video informative. Be sure to give our video a like, subscribe to our channel if you haven't yet done so, turn on notifications, and share a comment. Is this information speaking to you? What are your thoughts? What are your questions? We're happy to interact with you. Chris German from the Apartment Dealer, and as always, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.